Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, home of the Mean Green Fighting Eagles, I guess, if you will. It's a great school, love it there. And today I'm recording a lecture for my intermediate accounting 2 students at UNT, but it is fully available publicly on YouTube. So hopefully, if you're in another school, hopefully this will add some value for you. I am using the McGraw-Hill textbook, Intermediate Accounting. It's a Spiceland Nelson Thomas textbook, which is a great textbook. And for today, this is just an excellent. I could never have developed a presentation as good as this one that I got from McGraw-Hill. I love it. I've taught from it many times, and I think I'll explain why I love it here in a minute. Let me share my screen and get started here. So, well, let's start the slideshow. Gonna hide my meeting controls. You just get in my way, hide my face there. I want to see myself. So, yes, we're going to talk. This is the second half of chapter 19 from the textbook, and we're going to talk about earnings per share, commonly referred to as EPS. And boy, if there's a number there, I'll just say this: there's not a number from the financial statement that is more talked about than the EPS. And every company has EPS targets they're trying to hit. Bonuses are paid on EPS, but shareholders and all the Wall Street analysts, if you watch CNBC, they're talking about what they think EPS was going to be. If a company beat their guidance, what they expect to do, that was because they had a higher earnings per share than was expected by the market. And so why is EPS so valuable? Well, if I know my earnings per share and I know my price of the stock per share, now I could take price per share divided by the earnings per share, and I could get a valuation multiple. And if you know anything about finance, multiples are, when you're buying and selling the company, or even something like real estate, it's those multiples that determine if something has high value or low value. We call that multiple in finance the PE ratio, price to earnings ratio. And so we get that from the EPS. And so if a company has a $500 stock price, that doesn't mean it's cheap or expensive, because they could do a stock split, as we've already seen, and it's suddenly $250, and so that's highly manipulatable. What cannot be manipulated is the earnings per share in that. So if you got a $500 stock price and your earnings are $250, that earnings per share is only a 2 to 1. That's actually really low. The average PE multiple in the market right now, and stocks have been dropping in the last month or so. We were right in the middle of the war in Ukraine and inflation and everything that's happening right now. So you can't quote me on this, but it's been running around 17 to 18. So if a stock sells with a PE below that average, we call it, hey, that price is discounted. It's cheaper. If a stock is above that and their stock selling at 40, 50, 60 times, a 60 PE, they're high price stocks. Now they may be high price because people think the denominator, the earnings, is going to go up big in the future. So you see a lot of high flying technology stocks, not so much Netflix, but Netflix has a very high PE ratio because people expect that streaming to continue to grow. And so all of this little conversation here is back to how important EPS is. In fact, EPS is so important, and no other ratio is like this. It is on the face of the income statement for all publicly traded companies. And that's a GAAP requirement, that EPS. And you put EPS both for continuing operations and discontinued operations and net income. And those are the only places it's allowed. And we're going to see that there's going to be 2 earnings per share. It doesn't make this easy, I know, but there's going to be a basic earnings per share, and there's going to be something called a diluted earnings per share. And what is the market focused on? Diluted earnings per share. And so in generally accepted accounting principles, there are clear rules on how to calculate earnings per share. So what we're learning today is from those sets of rules. And you would think it'd be easy. Net income divided by average shares outstanding. You think that's all it would be. That's what we did in principles of accounting. Now it's going to get a lot harder here. And so here's kind of we're going to talk basic earnings per share, and that is earnings available to all common shareholders, net income really. We'll see there's some twist to that, divided by the weighted average shares outstanding. So companies could be buying back shares during the period, issuing new shares. So we're going to look at, or doing stock dividends, we'll look at the weighted average of these. Yeah, the calculation is harder when the number of shares change during the year. Now, earnings available to common shareholders, we are going to subtract dividends to preferred shareholders. Why? Because those dividends are required to be paid before common shareholders get a dividend. So those dividends are not available to common shareholders. So you're going to see we're going to take net income minus preferred dividends. Okay. So here's the fundamental easy calculation. And this is, we're going to follow this example through this entire presentation. 60 million shares were outstanding, for the whole period. No stock repurchases, no stock issuance, everything. 60 million. So and there's no preferred shares, just common stock. So 154 divided by 60, $2.57. And there's no diluted, well, we don't know, there could be diluted EPS, but we'll see that in a minute. Now, here is why I love these presentation slides. And every one of these slides, the writing in red is going to be what's new, because we're adding a new complication to this. So if we're going to add a lot, we're going to go through all the possible scenarios that can happen for this company. The 154 hasn't changed, but guess what? They've issued some new shares, and they issued in March 1. So now we got to think about the weighted average. This 60 million shares, they're outstanding for the full year. These shares were only outstanding from March 1 through December 31st, 10 months. So these 12, we're not going to take them all into the share count. We're going to take 10 divided by 12. So 10 divided by 12 is going to be 10. So 60 plus 10, we're going to use 70. And that's nothing more than just a weighted average math there. Now, the earnings per share has dropped from the previous slide, 257 down to 220, because we've got 10 million new shares, really 12 million, but the weighted average piece would be 10 million. Okay, stock dividends and stock splits, that's going to result in new shares outstanding. So we're going to increase the number of shares. And so, because as it says here, the shareholders' interest has been diluted. There's a larger number of shares, same earnings pie, but there's more people getting a slice of that. So this is unlike Treasury shares, which were issued during the year. When a 10% stock dividend is issued, we're going to look at a stock split, I think, later. But so June, see the writing in red, that's what's new. I'll keep saying this. Now, every existing shareholder got 10% additional shares. So in this case, we go back to the beginning 60 and multiply it times 1.10 to reflect that additional 10%. These new shares, they were only outstanding on March 1, but on June 17th, they got a 10%. Now we keep this math here because they're still only outstanding for 10 months, but they've increased by 10%. So now again, earnings per share has dropped. We went from 70 to 77 million shares, which makes sense. It's 70 times 10% equals 77. And again, thing to remember here, stock dividends and stock splits, that affects all the calculations in the denominator that happened before that date, not stuff that happened after that date. Now, the weighted average number of shares is reduced. Makes sense, right? If we reacquire shares, we buy some of the shares back. Remember chapter 18, Treasury Stock, they're not outstanding anymore. Remember, when we repurchase shares, even if we don't retire them, we put them in treasury stock, they don't get dividends. They don't get the vote, right? They are not outstanding. And so if we want to understand what is outstanding shares, that's issued shares in the common stock account, issued shares minus those stock shares that have been repurchased that are down in treasury stock. That's the outstanding shares. And we care about that because they're the only shares that are outside the company that get earnings and to get dividends and get the vote. And so that's why we only use outstanding shares in the earnings per share calculation, not the issued shares. Okay, 8 million shares on October 1. So these are not going to be multiplied by 10% addition for that stock dividend, but this happened after the stock dividend. So this is the new piece. So, you know, now kind of like this, we issued new shares on March 1. Now we are reducing share counts. So we're going to have a minus sign, -8. Still think about this from a weighted average basis. These shares were only outstanding. These shares were outstanding January 1 through September 30th, but they were not outstanding October, November, December, 3 months. So -8 times 3 divided by 12. So guess what? Number of shares have increased. Now look at this. So we had 77 shares at $2 per share. Now we're only at 75. Hey, everybody got a bigger slice, you know? And share buybacks, I've said before when we did chapter 18, very popular these days because they will grow the earnings per share. All right. Okay, now we've got preferred shares outstanding. And so as I said earlier, any dividends on preferred shares are subtracted from earnings before calculating earnings per share. So here you go, new number. They're going to tell us now, you know, after the fact, I got January 1 to December 31st, there were 5 million shares of 8%, $10 par preferred stock. And by the way, we know how dividends are calculated from chapter 18. I want to remind you, you're going to, once you learn something, you got to keep knowing it, right? It's not like learn it and forget it. So how much is the dividend? It's 8% times $10 par. So it's 80 cents per share. And then 80 cents per share times 5 million equals 4 million. So in total dividends, preferred dividends, companies required to pay 4 million. If they don't pay it this year, they're going to have to pay it next year. You know, remember the cumulative nature there. So we're going to subtract preferred dividends from the net income because this 4 million is not available. There's 154 million available to common, but not all of it. 4 million is not because we've got to pay those darn preferred shareholders first. So now we've got down to 150 divided by 75. See how great this presentation is? All the red is all the new stuff. Okay, that's it for basic earnings per share. Pretty easy. However, it might be misleading. Why? Hey, there could be some convertible bond, convertible for stock. We've seen that we can have stock options available to executives. You know, so contingently, so there could be, you know, hidden there, kind of, if you will, more shares that could just suddenly appear. And so you're buying a company based on a PE ratio, based on the basic EPS, and then suddenly there's a whole bunch of new shares. Where'd they come from? You know, oh, that's not going to work. That's going to be, you know, it's not going to really represent. It's going to be a surprise to shareholders. So, hey, the FASB, they're not dummies up there in the FASB who set the accounting rules. They're going to require you to show a diluted earnings per share. Now, this becomes a little confusing for students because guess what? It's all going to be hypothetical. We are going to assume that all these potential, not actual conversions have happened, that everything that could be converted, we're going to go convert it on our spreadsheet, in the math. They're not converted, but we're going to do it on a hypothetical basis as if these got converted. And we're going to see when we convert some things, hey, some of our numbers might change, even in earnings, because if we were paying interest on bonds that are no longer there, we wouldn't have that interest if the convertible bonds got converted into stock. So everything that we're doing here in diluted earnings per share is based on hypotheticals. The hypotheticals are based on actual securities that could be converted into shares. So hypothetically, we're going to go convert them all, hypothetically, and then recalculate earnings per share. So that's where I personally felt like this chapter, first time I taught it, was so easy, earnings per share. I guess I've been doing it a long time. I thought it was pretty easy. And I only had one example in class, and then everybody bombed that problem. So now when I get to my part B for this lecture and do problems, I do have not a bunch of them, but I do have 2 earnings per share problems that I'll work with you in the second lecture for this part of chapter 19. So let's go look at the slides first. So the first thing that could happen, we could have these option rights or warrants to exercise, as we saw with the executive stock options, exercise as a specified exercise price. And if they get exercised, there's going to be some new shares, more shares than that we have in the basic. Now, in the basic EPS, we deal in only what actually happened. No hypothetical, no potential. EPS is based on potentially what could happen. And so hypothetically, we're going to recalculate EPS as if the potential increase occurred. Now, here's the part about options. If someone exercises an option, they got to give us cash. And so we will take that cash, hypothetically again, and buy back as many shares as we could at the average market price. So again, all hypothetical, but this is something we could do. So APS, and I guess they give us any words and music around this? No. Here, 15 million shares got exercised at $20. 50 million shares got exercised here. And so the diluted, and I'm surprised they don't show us the data. Maybe I didn't include that slide. Regardless, so we got 15 million shares got exercised at $20. So we received in cash. I guess that would be 300 million. So we got 300 million in cash. And guess what? We issued 15 million new shares. Back to your stock option in the last chapter 18, last lecture. So, we add the 15, but we're going to assume we're going to take that cash, that 300 million in cash, and we're going to go buy stock. But we can't buy it at 20 because that's what they exercise based on their legal right, option at a lower price. We could only buy $300 million divided by a $25 price. And so we could actually buy 12 million shares back with the money we got to exercise those options. There's only a new 3 million shares added. Now, in the basic, we're still sitting at 75 million shares, but here now we're sitting at 78 million shares. We've diluted these 3 million. Did these shares get optioned during the year we're looking at? No. If they got exercised, they would already be up in the basic. These are things that actually happen. Here is things that could happen. And hypothetically, we assume they did happen from the beginning, day one of the year. And we increased the shares outstanding. Notice, and this is why we call it diluted earnings per share, it's smaller. $2 per share now became $1.92. So if we didn't do the diluted EPS, everyone would be counting on $2 per share, but they didn't know all these options were out there that could be exercised. And maybe in some of these companies like Amazon or Netflix, there are a lot of stock options out there for a lot of employees in those companies, technology companies, and that could actually go down more than just 8 cents. And so as investors, we're going to care. And so this diluted EPS is more important than the basic EPS. Now, there are some securities that can be converted into stocks. So there's two we're going to look at here: convertible bonds. So if you get a convertible bond, let me say this, companies sell convertible bonds that could be converted into equity. And so why do they do that? So they get a lower interest rate. So they know, hey, we're giving you a chance. You don't like the interest, the stock goes up, you can convert these into shares and maybe get more money back than what we would by just repaying the shares. And so now, and then we could have convertible preferred stock that could be converted into common stock. Those are the two that we're going to look at. So here, we're going to add the additional shares. We're going to assume these things got converted, hypothetically, in diluted earnings per share. But if convertible bond got converted, we don't have to pay interest anymore. Now, the one thing you got to remember, we got to think about the tax effect of that as well. Because, if we were paying interest expense, we were getting a tax deduction. So that interest wasn't costing us the full amount of the interest, it was costing us less, less because of the tax deduction. And so we got to take, again, hypothetically, we got to take all this into account. As if it happened, we got to figure every possible ramification that would have happened to the financial statements if this did happen. And so here we go. We got convertible bonds, and here the red part's what we care about here. We got these preferred stock, incentive stock options. We've already done all this. Here's the new one. Oh wow, the company has $300 million convertible bonds, and they're 10%, so $30 million of interest per year. Company's paying out. It's convertible into 12 million shares. So guess what we're going to do? We're going to add the 12 million shares, but we're going to subtract from the net income all that interest we were paying. We're going to add it back, not subtract, add it back. And here you go. In the red is the new stuff, right? There's the bonds. We assume January 1, beginning of the year, the bonds got converted, as they could have been, into 12 million shares. But guess what? Inside this 154 was $30 million of interest expense. So we got to add that back. Well, we don't get to add all of it back. We only get to add 60% of it back because our tax rate was 40%. And so this thing is only costing us 18 million, if you will, because 60% of 30 is 18. In other words, yeah, it had 30 in there, but also had a tax benefit in there. And so now we're at 168, and look at this, it's diluted. Now, you'll see this slide later, but if you did all this math and you end up with a higher number than $2 because maybe subtracting a lot of interest, you don't do it. You only do it for things that reduce the earnings per share, and this did $2 down to $1.87. So you always go for the lowest possible number after you do all your hypothetical math. All right, now we're going to look at convertible preferred stock, and we're going to calculate EPS as if the preferred stock got convertible to common stock. But guess what? We were subtracting preferred dividends, but if all the preferred stock got converted into common stock day one, January 1, we wouldn't have had those preferred dividends. So you'll see how I'll talk about that in a minute. So here's preferred stock convertible into 3 million common shares. And these are 5 million shares, 8%, $10 par value. Same ones but they're convertible into 3. So guess what? We add back the 3, assume they're converted for the full year, all 12 months, and we just don't subtract the preferred dividend. See how we subtract the preferred dividends here? The preferred dividend, that's not an expense. this was an expense hitting net income, bond interest. This was not an expense, but we were subtracting it in the basic calculation. Now, we would still subtract it in diluted EPS, but if we didn't convert it, but we converted them, they were convertible. There could be preferred shares that are not convertible, then I wouldn't subtract. But we converted those preferred shares, therefore there are no, hypothetically, no preferred dividends. And now we got to, we keep going down here. $2, we started, I think it was $1.92. Last night, $1.08, we get down to $1.85 on diluted. Okay. I've mentioned this. So after you do your math here, that's the last hypothetical. We're done here with all the math. I'm sure you're happy about that. But after you do all the math, if the result of that would increase the earnings per share, when we would ignore it when calculate basic and diluted. So we go with the lowest number. We are not going to increase. So you'll never see basic is X and diluted is higher than basic. Never, never, never won't happen, because we're only looking for the diluted piece. We want investors to focus on what is basic, including everything that's happened, and what if all the kind of things will be more bad or adverse for the earnings per share calculation. We only include those things. So I think here's an example. It was conversion of bonds. $1.50 is less than $2 diluted, so we would include that. So these were both diluted. You could, and I'm not going to, I tell you why, some of my class, when they're taking my exam, they say, hey, do we have to worry about the order here? Some of these anti-dilution, those are the really super smart students. They were really great students. I said, no, don't worry about it. I'm not going to trick you on a problem that, if you do. So to look for anti-dilutive, it might depend on which one you do first. So, you have to keep doing it in different orders to make sure that one of them is not anti-dilutive. So if you do preferreds first and then bonds second, it might look like they're anti-dilutive. But if you do preferreds first and not bonds first, it might be a different answer. So you want to be careful. And so you look at the order that's the most dilutive. So potential common shares, this is kind of a summary slide here. Stock options, restricted stock, convertible securities like bond and preferred stock, and tangibly issued shares. Are they in the basic EPS? No. It's only hypothetically done in the diluted EPS and considered. And the key is the word, if I can take control of my thumb there, potential. The key word there in diluted, we only include potential shares. And we recalculate it as if those potential shares were hypothetically real changes, real conversions as of the first day of the year. Okay, now we're back into reporting. We've just been measuring, right? Accounting is about measuring, not reporting. So where do we report earnings per share? Okay, and by the way, these are very prescribed. You're never allowed, and the Securities Exchange Commission will go after you if you do cash flow from operations per share. Not allowed. They hate that, by the way, and it's not allowed. Here's the place you put earnings per share. It's reported for income from continuing operations and discontinued operations and net income. So it could be in 3 different places. It's reported for all reporting periods. What you normally see, it's right on the face of the income statement. It's just so important. You could put it in the notes, but you never see that. Companies are putting this right on the face of the income statement. It's too important. And if a business did not have any potential common shares, they didn't have any of these complex structure, they could just report basic EPS only. So here's an example, H&R Block for 2016. Here's their net income, net loss from discontinued here, and you see how they're going to do basic, both for continuing, discontinued, and consolidated, total net income. And they're going to do deleted for all 3 as well. And so this is exactly how it looked, and they're doing it for both accounting periods. And again, this is important. You'll get multiple choice questions on this, guaranteed. That you know this, because you're not allowed to put it on any other financial measurement in the financial statement, like a gross margin per share. No, only on the face of the income statement on these 6 line items. 3 for basic, 3 for diluted. And with that is the end of my earnings per share calculation for the second half of chapter 19. And again, thank you for listening to me. My next slide, I'm going to do 2 earnings per share calculations. Thank you.